So you want to buy a house, but you've got student loans. Don't worry, most people do. Student loans are among the top reasons that people get denied for home loans. Working as a full-time mortgage loan officer, this is obviously something I see all the time. It really does hold back so many people from achieving their dream of home ownership. But it doesn't have to. A good loan officer knows the tricks of the trades, like I do, to get around these obstacles, and I'm going to share them with you. In this video, I'll fill you in on how student loans affect your ability to buy a home, as well as how you can avoid keeping you from home ownership. Hey honeybees, welcome back to my channel, or if you're new, my name is Ciara, and I do videos on finance and lifestyle. I'm a full-time mortgage loan officer, and I have helped hundreds of people to buy homes and build wealth, so I take everything I know and share it with you in hopes you'll build wealth also. And before I fill you in on all this tea, make sure that you are subscribed to the channel. If you're not already, hit the subscribe button so you can be a part of the Honeybee fam. And don't forget to hit that bell button so you can get notified when I upload. All right, let's get into it. Okay, so let's first go over the different kinds of student loan repayment plans. There's standard, graduated, extended, revised pay-as-you-earn, income-based or income-driven, income contingent, and income-sensitive. Now stay with me, there's a reason why you're gonna need to know what these different repayment plans are. So stay with me. In a standard plan, payments are a fixed amount that ensures your loan is paid off within 10 years, or within 10 to 30 years for consolidated loans. With this type of payment plan, you'll usually pay less over time than you will with other plans. Graduated. With a graduated repayment plan, payments are lower at first and then increase, usually every 2 years, and are for an amount that's going to ensure your loans are paid off within 10 years, or within 10 to 30 years if you have consolidated loans. Extended repayment means payments can be fixed or graduated and will ensure your loans are paid off within 25 years. With revised pay-as-you-earn, payments are going to be 10% of your discretionary income. Now, when we say discretionary income, that means income that is left over after you have paid all of your necessary bills. So think your rent or your mortgage, food, utilities. Discretionary is money that you have left over after all your needs are covered. Payments are recalculated each year and are based on your updated income and family size. So with this one, you're going to have to update your income and your family size each year, even if they haven't changed. Now, if you're married, both you and your spouse's income and debts will be considered, whether taxes are filed jointly or separate, with limited exception. With this repayment, any outstanding balance on your loan that hasn't been repaid after 20 years will be forgiven. And that's if all loans were taken out for your undergraduate study. Or they'll be forgiven after 25 years if they were taken out for graduate study. There's also pay-as-you-earn, and with this one, payments are going to be 10% of your discretionary income, but never more than you would have paid under the 10-year standard repayment plan. Payments are recalculated each year and are updated based on your income and your family size. Then we have income-based or income-driven repayment. With this, your monthly payments are either 10 or 15% of your discretionary income, but never more than you would have paid under the 10-year standard repayment plan. With this one, payments are also recalculated each year and are updated based on your income and your family size. You have to update your income and family size each year, even if they haven't changed. And if you're married, your spouse's income or debt will only be considered if you file a joint tax return. And with this one, any outstanding balance on your loan that has not been repaid after 20 or 25 years will be forgiven, depending on when you receive your first loan. But do note that you may have to pay income tax on any amount of loans that are forgiven. Then we have income contingent repayment. So with this one, your monthly payment is going to be the lesser of 20% of your discretionary income, or the amount you would pay on a repayment plan with a fixed payment over 12 years. And then this is adjusted according to your income, as well as family size and the total amount of your total direct loans. So with this one, you also must update your income and your family size each year, even if it hasn't changed. And if you're married, your spouse's income and debts will only be considered if you file your tax return jointly or if you choose to pay or repay your direct loans jointly with your spouse. Now with this plan, any amount that hasn't been repaid after 25 years will be forgiven. And lastly, there's income sensitive. With this repayment, your monthly payment is based on your annual income, but it divides it up so that your loan's going to be paid off in full in 15 years. Now that you understand those, let's talk about how they affect your home loan approval. The biggest way they affect this is through your debt to income ratio. One thing you really need to know, and pay attention and write this down and highlight it and bold it and italicize it, is that student loans are factored into your monthly DTI even if they are deferred or on forbearance. This is especially salient to what's going on right now with the COVID forbearances. So know that if your student loan is currently in any kind of like deferment or COVID forbearance, that payment does have to be put into your monthly DTI. Don't kill the messenger. I didn't make this rule, that's the government. And the higher your DTI, the lower your approval amount. And if your DTI is too high, it could cause you not to get approved. Let's break down by loan type how, this affects the loan. With FHA, for example, we have to count 0.5%, 0.5% of your total balance of your student loans if you don't have a standard repayment plan. If you have a standard repayment plan, we can use that standard repayment plan amount. We're either going to have to count 0.5% of your entire balance of student loans and make that as a payment in your DTI, your monthly DTI, or we're going to use whatever that standard repayment amount is. This amount has to be fully amortized, meaning that it can't be graduated or income based. This has to just be a standard repayment plan that is going to pay off the entire amount of the loan over the course of the entire term of the loan. With USDA, we also have to take 0.5% of your total student loan balance and use that in your DTI. So for example, if you have $100,000 worth of student loans, we would have to put a $500 a month payment into your DTI. With conventional, we can use your income-driven repayment amount or your standard repayment amount. And if you are deferred or in forbearance, we have to take 1% of your entire balance. So for example, if you have a student loan, but you have a monthly payment of $10 as a part of an income-driven repayment plan, we can use that $10 in your DTI as opposed to having to take 1%. Now, let's say your student loan is in forbearance or it's deferred or in the COVID forbearance. That means we automatically have to take 1%. So for example, if you have $100,000 worth of student loans, let's say your income-driven repayment is $10 a month. But let's say you're not on an income-driven repayment plan and your loans are just in COVID forbearance. We would have to take $1,000 payment and put that into your DTI. Whereas if you had an income-driven repayment plan, we could use the $10. So you can see how your student loans are structured and the kind of repayment plan is crucial to determining your approval status depending on which loan type you have. It can get pretty complicated, but this is why I say having a really good loan officer is crucial to being able to, get your home loan. Sorry, y'all, my battery went dead. So yeah, I said that all to say that the type of structure that your repayment plan is in is crucial to determining your home loan approval because it's going to determine how much your DTI is, and that in turn determines your approval as well as how much you get approved for. So student loans are really, really crucial in factoring in how they're going to affect buying your home. Okay, so now that you know the basics, let's talk about how you can keep your student loans from hindering your mortgage approval. Now, the best way to do this is to consult with a mortgage lender. One of the reasons I say this is because your mortgage lender can guide you on what kind of repayment plan you need to be in, whether you need to be in a repayment plan, not be in a repayment plan, be in deferment, be in forbearance. They can guide you on what the best structure is for your student loans based on what you're trying to achieve with your approval. My other tip is if you are going to, put your student loans in a repayment plan, make sure that you are making your payments on time. Student loans are reported on your credit just like any other line of credit, And I think people forget this sometimes or tend to forget about student loans, and it can cause lates on your credit, which can affect your score and your eligibility to get approved for a home loan. So make sure you're paying those student loan payments on time. Next thing I suggest is consider how you're going to tackle your student loan debt and how that translates to your overall financial short and long-term goals. I say this because if for example, if your main financial goal is to become debt-free, then obviously you would focus solely on your student loans and knock those out and tackle those. But let's say one of your financial goals is to buy a house. Maybe paying off your student loan before buying a house isn't going to be realistic. So that means you would approach how you structure your student loan in a different way than somebody who has the goal of being debt-free. So if you're trying to get a mortgage, you may move differently with your student loans than if you were trying to pay off debt versus, other goals. So really understand what your goals are, and that's going to help determine how you tackle your student loan debt. My next tip is to consolidate your student loans to reduce confusion and extra work. Like I said, student loans can be easy to forget about sometimes because we tend to have multiple student loans. Like, rarely do I see someone that just has one big student loan. It's usually a bunch of smaller student loans. These can be hard to keep track of. They may have different due dates. Consolidating your student loans, clears up a lot of the guesswork in terms of making sure you're keeping track of your total balance. Just having one monthly payment a month, it's really, really helpful. Even if you are in deferment or you're restructuring it, it's just easier to keep track of one solid student loan. And you can do this for free. I'll try to remember or find the website that allows you to, and if I can, I'll link it below. But you can do this for free. Don't pay someone to do it. It's super easy to do it yourself. And if that's something you want me to actually do a video on, then let me know. My last tip is to structure your student loans ultimately in a way that is most economical for you. If you are not making that much money, or you're just in a position where you can't pay off your student loans right away, try to get an income driven payment plan. Or let's say you're doing really well and you're having a great year, try to pay down more on your student loan. Always notify your servicer if you are unable to make a payment, because like I said, making those student loan payments on time is crucial to your credit and your ability to buy a home. So make sure you're always communicating with your servicer. If you're unable to make a payment that month, or you may need more time, call them and let them know. They will work with you. You may be able to get an economic hardship deferment, or you may be able to get your payment reduced. They may give you more time. If you can't pay it, it's okay. Just contact your servicer. So overall, really understanding how student loans work in terms of repayment and home loans can really be beneficial in giving you the best opportunity to get approved and to buy a home. All in all, you really need to be consulting a mortgage lender for them to ultimately determine what's going to work best for you. But I hope this video gave you a basic idea of how student loans work and how they affect your ability to buy a home. If you learned something new, make sure to give me a big thumbs up. If you haven't already, make sure to smash that subscribe button so you can be a part of the HONEYBEE fam. Hit the bell button so you can be notified when I upload. I have tons more content coming on home buying, financial literacy, and just lifestyle things that you won't want to miss. Thank you guys so much for watching. I love you to the bank and back, and I'll see you in my next video. If you find this content helpful, be sure to join my Patreon, where I'm offering more exclusive and bonus content on lifestyle and finance topics you already love, along with digital downloads, giveaways, live Q&A and coaching sessions, Discord access, patron shoutouts, and more. So whether you're a home buyer honeybee and want more one-on-one help, a business owner or loan officer wanting knowledge for success, or you just want to get to know me in a more personal way, you won't want to miss all the great content I have. So go to www.patreon.com/Ciara Elaine to join, and the link will be in the description.